Here we go. Hello, everybody. We have Megan, we have Caitlin on the line. Everyone else, I think, is going to be watching the replay. But today we have Megan, who is an amazing accountant. She's done a lot of work with our Strong Retirement Club. So, of course, I thought of her to speak with you ladies, especially we have different moving pieces where business owners, buying a house, different incomes, different things that we need to think about. And we're also, next session is going to be more about investments. So the taxes with investments, retirement accounts, all that good stuff. So Megan is going to lead us in a discussion today. You want to tell us a little bit about you and your background?
Sure. Okay, so hi everyone, my name is Megan Sherwood. I am an accountant. I am a licensed CPA in the state of New Jersey. I work both in the private sector, working on financial accounting. I actually work for the NBA as an accountant, but I also do taxes on the side of that. And as part of that, I do taxes for both individuals and businesses and kind of dabble into different tax strategies and helping you plan how to best work your finances so that taxes work out in your advantage. So the first thing I like to say when I do an introduction is that I think there are a lot of people who are very scared of taxes and don't really understand them. They don't want to understand them because they're so complex. And believe me, I absolutely get that. I know that there's a lot to it, but I think that every person should have some sort of ownership over their taxes. And that might mean not knowing every single line item on your tax return, but understanding what benefits you're getting versus what you're not, and what you can do in the future differently that might benefit you. Because I have had a handful of clients before who have not been understanding exactly what's in their tax return, and that leads to them having 4 or 5 years of missing out on a benefit that would have really helped them. And so while I understand that there's a lot of complexities to tax returns, it is a good thing for everyone to do their best to understand it. And I'll segue from there, and that's something I've always said on an individual basis, but I think it's especially important when you're running a business or starting a business, because the taxes can be very different, but the taxes when you're owning a business can benefit you in ways that when you're operating as an individual that they don't. So the first thing we'll talk about is when you are an LLC, which is a limited liability company, and I've been speaking with Jess beforehand, I think that those generally what a lot of people fall into. That's generally the easiest path into business ownership. And when you're an LLC, there are a lot of advantages that you can take for certain expenses that you maybe have never been able to take before. So just as an example, if you are an individual, you pay an accountant to do your taxes. 9 out of 10 people never get to take that deduction because there's thresholds for an individual that require it to be more than 1% of your income, and people don't want to spend that much on an accountant. No. However, when you're set up as a C Corp or either an LLC or a C Corp, you can take that deduction no matter what the amount is. So, if you're deciding between hiring an accountant or not hiring one, keep in mind that you're getting a benefit when for the amount that you had to pay an accountant that maybe in the past you didn't get. So while you might have to spend a little bit more for an accountant, you can get that benefit. So okay. There are a lot of expenses like that you maybe as an individual couldn't take, and maybe as an LLC you can. So it's a great thing to have the conversation early on with a tax accountant to make sure that you are planning well in terms of what expenses you're taking, how you're keeping track of your revenues and your expenses. It's a really good plan. It's a really good idea to plan that from the beginning and do your best to get a hold of that early on.
Okay, awesome.
So then continuing on from there, one of the things that I think is important to talk about is tracking your expenses as an LLC. Like I said, there's benefits that you maybe couldn't take as an individual, which are very important as a business. There are plenty of softwares out there that work really well for tracking these. I know QuickBooks is very user-friendly and can be pretty easily transferred into information that you can give to your accountant. And if you currently use something like a TurboTax to prepare your own taxes, TurboTax actually owns QuickBooks, so those softwares are very compatible. So it's maybe as simple as getting the app on your phone and tracking your expenses as you go all year, and then by the time tax return comes around, it's pretty easy for that data to get transferred. And it's a great way to make sure that you are getting all the benefits you need, because it's obviously very hard at the end of the year to look back and try and remember how you spent your money, when you spent it, and how that is going to flow into your tax return. Whereas if you're using something like a QuickBooks, it's a lot easier to do that. But all that said, I realize that when you're starting out, you might not have that many expenses or have that much of a volume that paying for a QuickBooks might not make sense for you. So if that's the case, there are still ways to do it that are free. You can always track your expenses in Microsoft Excel or Microsoft Word. There are ways to do it on a smaller scale. It's just important to, whatever you do, keep track of those expenses and keep those receipts, because you want to be sure that in the event that you're ever audited, you have that support. So when you actually file your tax return, you are not required to submit receipts for all of your expenses. That's something that's consistent with individuals and corporate returns, partnership returns, anything. But should you ever be audited, you want to be able to provide that support. And that is not something that necessarily falls on your accountant. Like, as your accountant, I'm not going to ask you, can I see every single receipt? Really, that's something that falls on you to kind of keep those and keep yourself organized so that you can always speak to that. Auditing can be a scary thing, but it doesn't have to be. You want to feel good about what is in your tax return so that if you're ever audited, you are comfortable speaking to those. So another complex situation that I've run into before is, and this happens often with married couples, and not to say that that's always the issue, but one person handles the finances and handles the money, and then eventually when the other person has to jump in and take over, there's a lot of gaps between maybe what was put into your tax return versus what you maybe believe to be your income. So for example, I worked with a client a few years ago whose husband had passed away, and he had been taking very large deductions for charitable contributions. And then after he passed away, she was asked, how can you support these? And it's a very hard thing to do if you're not privy to that information. So, whether you're an individual looking at your own tax return or as your business, if you have a partner, you want to be on the same page about the expenses that you incur, especially from a partnership perspective. You're both responsible for your tax return. You're both responsible for, making payments against your taxes. So you want to be on the same page as each other, and make sure that you have the same, appetite for risk in terms of what deductions you want to take versus what you might not want to take.
Megan, sorry. Another point, when I have a woman going through a divorce, about to get divorced, I tell her to bring her tax returns to her accountant, especially if she's never been the one in charge of the taxes or knowing what's going on, so that she gets clear on what is the household income, are they taking aggressive deductions, like you said,
right?
And to get an overall picture.
Right. And
that?
there are some, and that's a great point. There are some things that come into your income that you might not be aware of. Like maybe you and your husband or ex-husband shared a mutual fund and you are getting dividends for that. Like those are things that you might not know if you're not involved in the day-to-day. And it's an important thing to understand because those have tax implications, since basically everything has a tax implication.
Yeah. So it's a good way to figure out, there's extra income. Where is it coming from? Is it a CD, a fund, a stock? What's going on?
Yeah, definitely. And I think that, a lot of people who use, there's, like I said, there's many user-friendly programs out there for preparing your own taxes, like a QuickBooks or things like that. You can get a decent amount of information from there. Like at the end of preparing your tax return, it'll show your tax return and you're actually able to click into items and say, what does this mean? And I think that that's a great tool and something that if you're using that, it's a great way to understand your tax return. But it's also okay to ask that to an accountant, to say to your accountant at the end, it is your accountant's responsibility to make sure that you understand your taxes. And that's something that I take pride in. I really want to make sure my clients understand what we're doing so that they never feel like they're in the dark. Because I think there's a lot of situations where people and it's a product of, sometimes you're too busy to take the time to understand your taxes, or maybe you're not a math person, so you didn't take the time to do it. But you should never be afraid to ask your accountant, what exactly does this mean and where did this number come from? And when you ask those questions, it can only benefit you.
Yeah, and I'm guilty because Megan and I are going to start working together. I was using the accountant my father has used for years, and he would always bring my stuff with him to see the accountant. And I had no idea my accountant filed Eric and me as single for 2 years. And I was furious when I found out because it's illegal, right? That's a crime. And I forced him to refile us. Oh my gosh, my voice is going. And so, but it's really important to understand what's going on in your tax return.
Yep, it can happen to anyone.
Even though I trusted my dad to take care of it for me, he's not me, so he's not going to care as much as me.
Right. there are things that only you will know, and that is something that that's why it's a benefit for you to take the time and look at your, look at your tax return. And a lot of times that can lead to you even getting additional benefits. As you're skimming through a schedule that your tax return prepared, you might see a line and say, oh wait, I did actually pay for some advertising this year. How can I get that expense there? It's a good way to get an idea of things that you missed. And that's, the more, as you're building a business, you obviously want to get as many tax benefits as you possibly can. And there are a lot of things that you'll do in the early stages of your business that can really benefit you later on. And that's why it's good to have a good relationship with your accountant and be able to understand that. I think that, there's no accountants out there who work based on you're not allowed to accept a fee based on how much money you can save a client. That's actually illegal as an accountant. But there are a lot of times when, if you compare, what you paid for TurboTax, say you paid $200, if you go to an accountant and you spend $700, there's a lot of times that $500 is made up by finding things that you maybe didn't know about before, or that you didn't properly treat in the past. So there's definitely
any
benefit
type of planning. Any type of planning will usually save you money in the long run.
Yes, agreed. Just one small item. I know that if you're set up as an LLC, you paid a fee to the state in order to do that. That fee is tax deductible. So just little things like this as you go, you can keep track of. And if you're working close with an accountant, they can help you plan for that and do a good job of making sure you're maximizing your deductions and everything. So there are a lot of different ways you can be set up as a company in terms of both legally structured and tax structured. And one of the options that you may have is you can be set up as a limited liability company, but you can file a one-time election to be taxed as a corporation. And currently, under the tax law, the rate for corporations can benefit you in terms of taxes, just because the rate is as low as 20 or 21%, and that may be lower than your individual income tax rate. Now, that can vary based on your own personal taxes, and that's why it's hard to give a blanket advice and say to everyone, go and file as a make sure you file the form so you can be taxed as a corporation, because you can't really, it's hard to give that advice blindly without knowing your individual tax rates, which tax brackets you fall under, how that number might change over time. So it's just one way that you're going to understand better if you work closely with an accountant who can help you say, okay, last year your effective tax rate was only 18%, so you'll save 2% by not becoming a corporation. So there's little things that are going to be you might hear little tidbits from people that say, oh, you should definitely be taxed as a corporation. It is definitely a situation that you want to assess based on how your taxes, your income, and how you present your financials.
Makes sense.
So then I think one of the things that goes hand in hand, like I mentioned, you want to establish a relationship with an accountant and establish a relationship with a financial advisor, someone like Jess, who helps you keep all of these things together and tie together your investment activity and your business activities with your taxes and how you keep your finances in check for all of that. One other item that I did want to touch on briefly is there is a self-employment tax, which is essentially, I see your question, Caitlin, I'll get to that in just one second. So there's a self-employment tax, which is essentially your way as an individual of paying for Social Security and Medicare, which you previously, if you were employed by a company, they would pay that and it would come out of your tax, it would come out of your check and they would pay that over for you. Basically, when you become a sole proprietor or an LLC, you then are required to make those payments into those taxes to receive those benefits later on. And that is a tax that is generally, as long as you're making income, you're required to pay a self-employment tax. So even while you may think, oh, I'm not really making a lot, my taxes won't be much, that is just a straight calculation off of your income. And that's something that, is going to be required to pay. But like I said, it's later on down the road, it'll be treated as if you were paying directly to Social Security, which is a benefit that obviously we want to plan for. So let me take a quick break. I'm just going to read Caitlin's question. Yes, so you can make a one-time election. Caitlin's question here is, so you can file as a corporation one time without becoming a corporation. So First question for there is, you can stay as an LLC, but choose to be taxed as a corporation. It's a one-time election that you make. It's a form that you file with the IRS. You're still an LLC, so your liabilities are limited to what you've invested in the company, which is obviously a great benefit of an LLC. But from a tax perspective, you'll be taxed as a corporation, and that can lead to there being a lower rate. But again, it depends on your rates.
And that's just once in a lifetime, or?
Yes, it's a one-time election that you can make. No, you make that for a lifetime. It's not just 1 year. You make the election one time, and then from that point forward, you are taxed as a corporation.
Okay, I didn't know that. Cool.
Yes. There are ways to revert that back to being taxed as an LLC later on, but in my research and my work so far, it's pretty hard to get them to switch you back at that point because you're already in one system for taxation. So it's a one-time election you make, but it can benefit you obviously later on.
Okay.
And then second, which means you are entitled, Caitlin asked, which means you are entitled to Social Security if you have been paying that tax. So if you are paying self-employment tax, you are going to be eligible for Social Security. There are some thresholds there in terms of how much you've contributed versus how much you make. There are some guidelines there, but yes, you will ultimately be eligible for Social Security by paying into self-employment tax. And then lastly, is there a disadvantage to switching to a corporation? The only disadvantage there is the potential for the uncertainty in what the corporate tax rate would be. So like I mentioned, the corporate tax rate right now is 20%, and that is great, but it used to be 35%. So if you were an individual and you fell in the 28% tax bracket, when you are paying taxes at 20%, that is a great advantage. But if that tax rate jumps back up to 35%, then there's a disadvantage there. So you're kind of weighing it based on what you expect the tax law to do, which is an impossible thing to predict. But the tax law that is in place currently does not, for the corporate law, does not have a timestamp on it. On the individual side, it was actually the current tax plan, which is drastically different from the prior tax plan for individuals. That actually only has a 5-year, only a 5-year term. So in 2024, if no other resolution is made, we'll go back to the old tax plan, which means in New Jersey, you can take your full property taxes. There's no thresholds that you have to follow. So that is on an individual basis, there's always a term, it's 5 years. On the corporate side, the new tax plan, which the corporate tax rate became 20%, does not have a timestamp on it. So it is that until another law gets passed to change that. So
okay,
the risk there is obviously changing in presidency, changing in political affiliations can obviously drive those things. So that is difficult. But like I said, there are ways to switch back to being taxed as an LLC. Just it is a complex situation, and you would want to talk that through with your accountant, definitely. And I mentioned this to Jess before. I am available if anybody's looking for an accountant. I am happy to do a consultation with you free of charge to kind of get an understanding of what your needs are and how I can help you. So if after this call, if any of you want to, set up time, I'm happy to do that. And I think that we can get a little bit more personal in one-on-one sessions about what your current situation is and how we can work for that.
I'll put that in the email with this recording to everybody.
Yes, great. Thank you, Jess.
Megan.
Okay, so then unless there are any other questions, I think I'm all set here. I try to keep it general here and not get too detailed, but eventually we will get too detailed.
Can you just explain tax brackets real quick?
Sure. Tax brackets. So the way that the current tax law works, you pay taxes based on where your income falls. Mm-hmm. So it'll be a certain rate up to certain dollar amounts. And for federal purposes, I can share that with Jess. It's a pretty simple table to look at. I'll share that with Jess so you can get an idea of where you fall in terms of brackets. But essentially, the more you make, the higher your tax rate becomes. So on your first, just to keep it really simple here, your first $10,000, the rate might be 1%. But on the next $10,000, so from 10,001 up to $20,000, your tax rate's 10%. So each dollar that you make will fall into a different bucket, and that determines what your tax bracket is. But all that said, like if you're an LLC and not being taxed as a corporation, so you're just being taxed through what's called a Schedule C, which is a business income that falls into your individual tax return. You're essentially paying whatever your individual income tax rate is. That's what you're paying on your money from your business as well.
Awesome. Yeah, because some people think I'm 20% tax bracket. Everything gets taxed at 20%, but it's not. It's a ladder, like you said.
Correct. Like each dollar within certain brackets gets taxed at a certain percent. It's not every single dollar is 20%, right?
Right. Oh, Caitlin had another question.
Okay, sure. If I'm at the highest tax level based on my husband's income, so I shouldn't file my business taxes with him, correct? Or is that illegal? Perhaps better to switch to corporation. So that is a situation where you would definitely want to look into switching to a corporation, I think, depending on, obviously, the caveat there, without knowing all the information, but generally, if you're in a higher tax bracket, it would benefit you to be filing as a corporation. That is the general rule, but there can be differences between certain deductions you can take and can't take. But you are required to either file, because you're married, you're either required to file married filing jointly or married filing single, but you can still file as a corporation for your business income and still be taxed based on the corporate income tax rates versus your husband's income tax rate. I don't want to get into too much detail, but yes, there are ways to set it up so that you're being taxed at the corporate rate, which is lower than what your income tax rate is.
Caitlin, can you put in the chat if you have an accountant?
Okay, so
here if I just talk.
Sure.
So yes, I have an accountant, but I don't really have I don't have a relationship with him. It is through my husband, who's had the relationship for a really long time.
Yep.
I have tried multiple attempts to be able to meet with him and sit down because I realize I don't understand any of the taxes,
right.
Only from an individual level, but for my business. And so in an effort to become more financially literate, I'm working towards understanding what it all means and what my options are. And I realize that some of my questions, I'm asking because I don't know what kind of answers I'm going to get from him and whether they're going to be biased or steered towards the benefit of like my husband's financial situation rather than mine. Does that make sense?
That would be good to bring your last tax return to Megan.
Yeah. Mm-hmm. Like if you want to do a consultation, I can definitely take a look at that and help you get that idea, because I mean, generally, if with you and your husband still being married, he should be looking out for you as a couple, what's going to benefit you the most as a couple. And that might be being as an LLC or being as a corporation. Are you actually sure that you are not being taxed as a corporation currently in terms of your business income?
You know what? I don't know that. I know that I'm an LLC, but I don't know technically what they're claiming or what they're kind of taxing me. I don't have any of that information, which is part of the problem.
No, it's a problem that a lot of people are finding themselves in, where they, haven't always been privy to the information, and that definitely happens.
And I was told that whenever I talk about what I can deduct as far as the business, because I do have a home office and I do actually do home visits, which means in my car all the time. And so I'm always constantly asking those kinds of like deduction questions.
Yep.
And the response I get from my husband every single time is, we already claim max deduction. It doesn't matter. Like none of that matters. We are already claiming the max deduction. So my question to you is the max deduction a percentage of income, or is it some kind of like flat rate for everyone?
Interesting question. So I know on an individual basis, the itemized deductions that you can take is, there are certain ones that are of a dollar value. Like just for example, your property taxes, and your maximum that you can take is $10,000, no matter how much you pay in property taxes, that's what you can take. So that one's a set dollar. Some of the other ones are percentages, like medical expenses are percentages. Things like home office and mileage, both are percentages as well. Mileage is based on, you either have to track individual mile you drive, or if you're using your car only for business, you can take the difference between your mileage on January 1st and your mileage on December 31st, which may be what's happening in your case, but I'm not sure. I'm not sure specifically.
But what my question more was, as far as the deductions, like he's basically saying it doesn't matter if I track my mileage or try to deduct that, because we can't possibly get any more deductions than we're already getting on our taxes. We're at like a max level.
Okay, I don't think there's actually a max in terms of business deductions.
Yeah,
but all that said,
too. It depends on your income too.
It does. So certain ones depend on your income, but as a business, there are not really set limits on the deductions you can take. So, are you using a software like QuickBooks or something like that for your expenses?
For my business, no.
Okay. So then I would find it hard to believe that you're getting the max deductions without having tracked like every single expense in that.
Well, I think that's what he's saying is that the accountant, because they don't even ask me. They don't like say, I want to see all of your, expenses. I want to see your mileage. I want to see this or that. They're just, they're kind of basically just filing the taxes and telling me we've claimed max. And so I don't know if that's something that's a little in the gray zone where they're just kind of clicking a box for max deduction, which I remember when I used to file my own taxes prior to marriage, that there was, kind of a box that you click that's like at max level. And I don't know if that was for my business.
So that's what you might be thinking of is when you pay individual income taxes, there is the standard deduction versus itemizing your deductions.
Got it.
And before you like own a house, generally your itemized deductions will never be more than the standard deduction. So it will just always benefit you to do standard. And so that might be what you're more familiar with on the on like an individual basis.
Like that on business.
There's nothing like that on business now.
I'm guessing he's getting your income down to 0.
Yes.
That's what I'm
That is a good guess. If you're claiming that you can't claim more expenses than what your business makes. So my guess is they're getting you down to 0, and that's what they mean. But all that said, you should still, keep track of, you should still know what you're making, your income versus your expenses, because that can help determine how you structure yourself as a company too. So.
Got it. Okay.
But I would be happy to sit and talk with you and take a look and go through your return in more details. And, it doesn't necessarily mean, you have to fire your accountant and come to me. Like I'm also here to just help you and help you understand so that you can maybe, make the changes that you need going forward.
But there isn't a way that I could separate out and do my taxes for my business with you and allow him to kind of do our personal taxes. It doesn't work like that, right?
Technically it does. It could work like that. I would do just your corporate, and then I would have to give that information to him to put into your individual income tax return. Okay. But if he is currently working in a way that your income is 0 from your business, it might not be beneficial to do that, but it is possible though.
Okay. Got it. Thank you. Very helpful.
You're very welcome. Yeah, great questions. I think it's good to hear what your, day-to-day questions are, and I'm happy to help.
Awesome. I'm going to stop the recording. Thank you, Megan.
Great.